Okay, let's start this webinar. We should be much better now, right? Refresh everything if you're still not able to hear or see. It should be fine now. Okay. All right. So I'm going to go back to the beginning, just because I want all this to be recorded for people. So basically, what I had started out saying was I was just pointing out how there's a big difference between just kind of throwing up your hands and saying, oh, this market's very choppy, I don't know what it's doing, and using trend lines to really be objective and know, okay, well, the market is not doing what it's supposed to be doing because it's breaking trend in two directions and not following through. So that's basically what I was talking about. And this is a perfect situation of that, in that this is a trend line break failure, which then goes back above the trend line, correct? And this is a trend line break failure, which then goes back below the trend line, right here. So if you look at it, objectively, instead of just saying, oh, well, this market's very choppy, this is kind of more like the proof that the market's choppy, basically. It's like when you see these trend line breaks fail, this is not the way the market should act, right? When a trend is broken, it should keep going. When you have these sort of very vicious 100% retracements back and forth like that, that's when you know that the market is really trading kind of emotionally and is probably waiting on more information. Usually this is what happens when the market's waiting on more information. You have people kind of trying to get ahead of it, not sure of themselves, whatever, and you get a lot of this chop. Okay, let's move on to what I wanted to talk about, which is how being net short is a big secret to not losing money. So the first thing I'll say about that is that I said one time that the success of a trader over time has a lot to do with the market. If the trader sticks to their knitting and stays with the same strategies over and over, then the amount of money that the trader makes, if they stick to the strategies and they just keep doing the same thing, think about it. The amount of money the trader makes has to be decided by the market and not them. Because if you apply the same thing in different market environments, in some market environments, it's going to rip in your favor a lot better. Let's say you're doing risk reversals, etc. Or even if you're just selling credits, regardless of how you're selling them. If you are constantly selling call credit in a down market, you have a good chance of having 100% odds of success. If you're selling call credit in a mixed market, you will have 50-50 odds of success. If you're selling call credit in an up market, you'll probably have less than 50% odds of success. So in that sense, the market defines what level of success we have by a lot. But I want to add another twist to that, in that the way that I trade options, and I hope that those of you who are new here in the trial, you're starting to realize that you can tilt those odds strongly in your favor by being net short. And when you're net short, what you're doing is you're leveraging the power of time and letting the market do a lot of the heavy lifting work for you. So we're just going to look at 3 trades from our recent history, one of which we're still in, which is Tesla. And then we're also about QQQ and then the number 1010 SPX. All right. So let's start with Tesla, number 1008. Would you agree that from the entry, and you don't need to answer in chat, this is a rhetorical question. From the entry, we were wrong. I shouldn't say we, I should say I was wrong on direction. Absolutely. I thought that the stock, having retraced 100% of this big up move, was going to do what it should do, quote unquote, which is come down to the trend line, which would have put it right into the 840 pocket, right? That 840 is divided now by 3, so it's in here now, okay? That was wrong. It didn't happen. But do you see how yesterday, when we had this, we immediately got out of one of the structures early and then left one on, kind of thinking, okay, it could still happen. I'm not ready to give up on the whole trade. But do you see how, like yesterday, when the stock's rallying, by adding this 45, we are wrong. Let's say that we're, and we never get anywhere near our strikes. Do you understand how we keep this entire $1.45 against our structure? And we've put it in the middle of the spread where it's not going to hurt us as much as if we had done it somewhere higher up or whatever, right? Essentially, we're selling a vertical against the cost, and we're looking to keep it all. And in doing so, we're still leaving ourselves with the important part of the structure, which is this put right here that could still actually make money. So this is how the power of net short basically allows you to not lose money, basically, when you're wrong, is that these spreads are more forgiving if you're wrong on direction. Whereas if we had bet on the direction with this spread, which is the typical way that most people do it, we would be hurt. Or with this spread, which is the one we did without converting it, we would be hurt because this is going to lose value so much faster than this. And in both of these situations, or should I say in these three situations, what's important to note is, and that's why I circled this never changed. We are still long the highest put there is in the structure. And that's really an important point, is that you've taken in all this credit to knock your costs down considerably, but you haven't disturbed the sanctity of the part that's going to make you money. It's still there. You see what I'm saying? Like how like that's hard to do with a vertical or with long stock or whatever. It's like you can kind of have it both ways. When you have a broken wing butterfly or an unbalance, you're literally having your cake and eating it too, because you can still make the same money directionally. You're just paying so much less so that if things fall apart, you're not hurt. And that's why if you look back on our history, and I invite those of you who are here in the free trial to do this, you will see that that over time, it's been proven, over 1,000 trades, the winners are so much bigger than the losers. We have losers just like everybody else, of course. No trader has only winning trades. But do you see how you have losers in the history that are $40, $50, $90, and then multiple hundreds on the winners? It's because of this structure. And that's what I was saying, is that I'm going to wrap this part up by going back to the first thing I said, is that if you trade the same thing over and over, the market decides how much money you make, right? But adding on to that, if you trade this type of structure over and over, right, the structure decides how little you lose. The structure helps immensely with that. It's a big, big difference. Okay. Let's move on to an easier, maybe an easier example to grasp, because it's a purer example of this. And that's the QQQ here. So, and also, oh wait, before I even get into that, before we get off Tesla, because we're going to do this with the Qs, any option can be charted. Any option can be charted individually by just going into the chain and right-clicking and say copy. And this is that 280 put that's in the middle of our trade. And this is only today. But look at how bad it got beat up from the high of the day, which is 80 cents, to now 25 cents. So this is like the power of what's happening that's helping you to get your costs down low and keep your trades making money. And remember as well that, you know, you could make the argument, well, okay, all the puts are attritioning, right? Even the ones you're long of. You are correct. But you are short 3 of these. That's the big deal. There's 3 of them working in your favor, and there's only 1 working against you. All right, so that makes a huge difference. Okay, let's move on to QQQ. And as I was saying, this is a more pure example of what I'm talking about. So in this trade, we wanted to go directionally. And the trade ended up just being break even. But this is another perfect example of how this trade could have been a big loser. We are looking at this support level here. No, it wasn't a support level. It was fib, right? It was fib, I believe, whatever we were looking at for the 301. The midpoint right here, the midpoint of this. So this trade was put on for an 87-cent debit, the 311 to 301. And what's noteworthy about that is that it was 3 short of the 301s. And at the time that we had put it on, you can just go copy like this. That's how you get this. Let's get an hourly. Okay, look at the hourly here. And this trade was put on at 2 p.m. on August 22nd. Right here. So those shorts were somewhere between 65 and 70 cents. And notice that now it's 3 cents. And that paid for, that is, think about how much that knocked down the price of the 311s. Because we can just change this to 311 and look at the exact same time period, 2 p.m. right here, $3. So can you imagine if you structured this differently and you said, yeah, I think this market's tanking and we're trading 313 or whatever. I'm going to buy the 311 put, and you paid $3 instead of 87 cents. Right? And that's why, again, and I bring this up again, it's very similar to Tesla. We were essentially only right on direction in this trade for a hot minute. Then it just turned around and it never followed through. But in following through, when you have those 301s going to zero, it makes a huge difference. It makes a huge, huge difference because that which you bought this way for 87 cents is going to act completely differently from this or even this. Right? This is going to act so much more in your favor because of this power here that it's given you. And you can't just do this all the time. All right? Be aware of that. You can't just do this all the time. The main way that I trade, and again, I hope, you know, this is coming across because that's really it, is that you always want to have this stuff in what are relatively safe areas against levels that you believe in. If you can find a level that you believe in and say, okay, you know what? I just, you know, yeah, I think it's going down, but it's not going to cross this mark here. These are the areas where you should exploit this type of structure to make it worth your while so that you can get the directional part on that you want as cheap as possible. Okay. All right. Last one we'll look at is and again, last thing on the QQQ, just understand that, and this is really the big thing. Had we structured differently, this trade ended up making $5. That's really break even. But that's important Because again, remember, you're not going to be right all the time, and the market's going to do strange things. Like to me, I thought the market would go lower. I thought we would hit the 50 MA, right? I thought we would come to that 50% retracement. It seemed to be some pretty hot and heavy selling to me. It looked to me like, okay, this is a 100% retracement here, so we should probably continue, and maybe a weak bounce, we continue, whatever. But it didn't happen. So imagine how much better you would be. Better you'll be at the end of the year if you can make all of those times that you're wrong not cost you much. This is also, and I'm not going to talk about this in this webinar, but do you understand that this is also why I'm always willing to sort of, I don't want to use the word gamble, but you notice that I almost never go long without doing the risk reversal, because I understand that the nature of options is to lose value at time. And I might be right on the direction, but I could be wrong on the time. So during the time that I'm wrong on the time, why wouldn't I want the engine of short puts draining out to pay for the call, so that it says, oh, well, I was right. The stock did, I thought the stock was going to go up $7. It only went up $2. Okay, no problem. The puts paid for the calls. I didn't lose anything. I'll try again next week. Whereas the people that buy stock, maybe they make a little or they're hurting. It's going sideways, tying up capital. The people who buy call verticals are completely screwed, because they thought the stock was going to go up 7, and all they did was buy a call vertical, and they spent $1.75 on it. That's now trading for 30 cents, right? And again, where and why do I sell the puts? Like, let's just pretend that this chart was a risk reversal, so I don't have to switch charts. Just go like that. Short puts here, right? Long calls going up here. Why? I trust this level, right? And I totally understand that if you're wrong, you're going to be doubly wrong, right? Your calls are losing money, and now you're going to have to deal with these short puts. I get it. But if you have good TA and you really trust your levels, which a lot of trading is really just trusting your levels, is really just setting the levels and being trustworthy and not jumping out too soon or whatever, then to me, this is the right way to go about it. And even when you're in a risk reversal situation, you're still kind of net short. Maybe you're not net short because you're the same amount, but you're leveraging the power of how the options market really works, which is what, right? What's the big secret of how the options market really works? There's really just there's one explanation of it. And it's simply this, is all the prices are distributed along this curve, and this is at the money. And all of these values here, right, as you go further away from at the money, right, these values are constantly getting smaller, as are these values getting smaller. And every moment that goes by, pretend these lines are hours or days, tick, 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 tick. What is happening to all this premium? It's all crunching. I call it crunching to the middle. So that's why something like a broken wing butterfly, for instance, makes perfect sense, because, for instance, in this structure where you know that this exists, right? This is absolute. This is going to happen every single day, every moment, forever. This is not going to change. And your idea is that you think it's long. So you're here and you think that price is going here. Well, then why wouldn't you want to be like this, so that you leverage the fact that the odds are way in your favor that all the crap up here is going to zero. All this is going to zero. And this one's going to be worth something. So that's your ratio moving in that direction. Or it could be your BWB, right? Where you have the other one way up here. Doesn't matter, whatever, just being net short, right? This is net short because the width is greater than that. So that to me makes sense. That, is how this should be, working, is put on options trades at all times that exploit this time factor. All right. Okay. Last one we're going to talk about is the SPX. And this is a pretty simple It's, I mean, not simple in that the spreads were complex and it was two BWBs, two unbalanced BWBs, excuse me, and one was more narrow and one was tighter. But I'm going to end on this example just to show you, just to talk about the power of how that went from, 50 cents to 5 cents so quickly over the course of a day, because the structure was 132, basically. That would not have went so quickly if it wasn't like this, right? That was the whole thing. And we had two of them on where one was more narrow and one was like this, right? One was wider. And obviously the more narrow is going to bring in a bigger credit, right? That has a bigger credit. And this one brings in a smaller credit here. And why? Because you get what you pay for and you're getting more long exposure here. You have more positive delta here. So this is obviously going to cost more. So you have this one at 50 cents and this one at 85 cents. But when time is super short, and again, this is more of that because this only had one DTE, right? It was that day plus the next day. Think about this as well, and I'll just end on this note. When time gets super, super short, this thing we just talked about, this big secret, this starts accelerating like super fast and also becomes very, very sensitive to price movement. We call that gamma, right? What is gamma? Gamma is the delta of the delta, right? It's how fast the delta starts to move and when the time is short. And obviously that cuts both ways and can hurt you, but it can also help you hugely. And the theta also accelerates hugely, right? The theta accelerates hugely when that time is short, which is obvious because we know that the decay of options over the last 2 weeks, the decay of options is always, is not like this, is not linear, correct? It is strongly accelerated when you have 2 weeks to expiry. Imagine that this line is 2 weeks. This is when it starts falling. And notice that it accelerates and the slope gets faster and faster. And I may have exaggerated this part, but when it gets down to like a day, it pretty much looks like this. Whereas it's this gradual movement like this. This is what's happening, and on the last day, it's just going straight down. It's literally going straight down, right? Essentially, for any stuff that you're short, okay? So that is it. That to me is what I call the power of being net short. And as we know, the net short can happen in a multitude of different ways. Net short is when your short vertical, right, is wider than your long vertical, or if you just have more short verticals, even if they're equal. I always like to use these little brackets, right? That's one call vertical, that's two call verticals. Always think of every complex spread as the building blocks of the spread. It's really just 3 verticals. Ratio spread is really one long vertical and one extra naked call or naked put, one extra naked option, always. And that's why if this is very narrow on a ratio spread, it's strictly for collecting credit. Whereas if it's really wide, you can really do well on it directionally because you're going to get it cheaper. And this +1 is going to overcome these shorts because this distance is so big. So you can think about that as well. All right, that's it. I think I will end it there. Hopefully that was at least somewhat illuminating to you guys. And that's it.